In Lesson 1, you are introduced to several different types of investment options. Let's look at these in detail and determine the advantages and disadvantages of each. First, let's start off with stocks. These are like owning a little portion of the company, or we also call this equity. As a result of having that equity stake, you have a claim to some of the assets and the earnings of that company. The positive to this is because we are part owner with that equity stake, we have voting rights to the company. Also, over the long term, equity has shown to have higher returns than some other different types of investment options. Because we have claims to those earnings, some companies pay this out in the form of dividends, and these are cash payments to each individual investor. Unfortunately, stocks can also be very volatile, and as a result, we can lose all of the investment that we have put into the company. Now let's take a look at bonds. Bonds are a type of investment where we loan a lump sum of money to a corporation or to a government, and in return, they'll pay us back interest payments until the end of the bond term, which we get our full lump sum of money back in return. The advantage to this is that we know the rate of return we will be getting from the government and the corporation. Unfortunately, the interest that we earn is considered taxable income, and throughout the period of the bond, it is not transferable. This means I can't give this bond to my friend or to my parents in the event that they want to earn that interest instead. The next type of investment vehicle is real estate. This is like owning property or land, maybe a house or a condominium. The advantage to this is we can earn an income stream from that investment in the form of rent. The negatives to real estate is that we definitely have liquidity issues, and this means it's hard for us to sell the investment right away. You may have seen on the news information coming out about housing markets coming down. This shows the huge potential for loss we have in real estate markets, as all of those individuals are now taking losses on those investments they made in real estate.
The 3 rules of real estate? Location, location, location.
Now let's talk about treasury bills. These are also known as T-bills. These are short-term bonds issued by the government. We know the rate of return we will be receiving, and in the case of Canada, we know that the government is reliable and will be able to pay that out. Treasury bills pay a very low rate of return, and as a result, may not be the most attractive investment option. Now let's talk about savings accounts. These are a type of bank account that pay us interest in return for us leaving our money with that bank. We know the rate of return that they will be paying to us, and it's really easy for us to go and access those funds. We can walk into the bank any day and ask to withdraw from that account. The negatives to savings accounts is that those rates are incredibly low, and because we're getting our services from the bank, we do have to pay fees on occasion to access those funds. Our next type of investment is a GIC. These are known as guaranteed investment certificates that we go to the bank and buy from there. We know what the rate of this is going to be, and in Canada, we know most of our banks are fairly reliable and won't be declaring bankruptcy anytime soon. The negatives to this is the interest we earn is taxable, just like bonds, and unfortunately, there is also a penalty if you sell out of the GIC early. Now let's look at ETFs. ETFs are exchange-traded funds, and what these do is track an individual index, say like a stock exchange, or a basket of assets, say a pool of stocks, but they trade as one individual item on the exchange. These have lower fees than mutual funds, and they can help us quickly achieve diversification. Sometimes we have issues with liquidity on ETFs, and it may be difficult to sell the investment when you want to cash out. Now let's take a look at RRSPs. These are registered retirement savings plans, and you may have heard your parents reference these from their own bank accounts. This is used as a form of a tax deferral. The income that they've earned in that year can be used to pay those taxes later. In this type of account, we can usually invest in just about anything, whether it's stocks, bonds, or ETFs. If you were to cash out of these positions early, there is a penalty for having taken that money out. Another type of investment vehicle is an RESP. These are registered education savings plans, and these are meant for your educational pursuits after grade school. The advantage to this is having these accounts enables contributions from both the federal and provincial governments to help you give a little bit more money when you're out of school. However, if you withdraw this money early or you don't use it for educational pursuits, there may be penalties you'll have to pay for that. Another option is mutual funds. Think of these like a grab bag of stocks and bonds. A lot of investors like these goodie bags or mutual funds because they help us diversify quickly. Now, there are lots of types of mutual funds out there, and we access these through our local banks. Some of these different types include income funds, which would hold lots of different types of bonds, or an equity fund, which would hold a variety of types of stocks. Maybe a cash mutual fund, which is holding various types of cash instruments like T-bills or GICs. We also have balanced mutual funds, which would take a combination of both cash, income, and equity funds and make some type of balanced mix in a percentage that made sense for your investment. Let's say you're interested in protecting the environment. Did you know that you can go and invest in certain types of mutual funds that will align and match with those types of values that you hold? These types of funds would be known as socially responsible or values-based type mutual funds. The advantages to mutual funds is that these are often professionally managed. Unfortunately, this also means we have to pay that individual for managing that fund. This fee will come off the top line regardless of the performance of that fund. As a result, there's no guarantees that just because it is being professionally managed that we will have high returns in that mutual fund. As a result, it is important for each of us as individual investors to do our research and due diligence on those investments before we make them. In this video, we saw how stocks, bonds, GICs, treasury bills, mutual funds, ETFs, real estate, TFSAs and RESPs, and RRSPs all have advantages and disadvantages. Some of the advantages include reliability and tax deferrals, while the range of disadvantages vary from low rates of return to penalties for early withdrawal. Mutual funds are one way to diversify, as you put money into a variety of stocks, bonds, and other investment vehicles. Now that we covered the various investment choices, it's time to look at them in greater detail. Which one is right for you?